Coming up in today's show, stocks finish lower, ending a 5-day winning streak. I look at what Fed members think of inflation and interest rates, the market's reaction to Nvidia's earnings, investors are coming back to the stock market, gold closes above $2,000 an ounce, uranium hits 15-year highs, and the founder of the world's largest crypto exchange pleads guilty to criminal charges. Hey, what's up guys? Thanks for tuning in to the Click Capital Daily Market Show. I'm your host Jared, and I'm going to get you all up to speed on what's going on across financial markets with not only a curation of the best financial content, but also some technical analysis of the charts and what the underlying trends and themes in the market at the moment are. And so overall, it's a bit of a bearish day in the market, led lower by the semis and tech, bit of weakness in small caps, and just a few pockets of green out there. And what's looking like a bit of a sleepy, low volume, low volatility Thanksgiving week. And we can see that in the daily chart, the S&P 500, only having a 17-point range today, closing down just slightly lower at 45.38. And same with the Nasdaq, which came off a bit more on really low volume. And it was the small caps that were the weakest today, but again on really low volume. And that's probably something that's going to persist, because don't forget the US stock market shut all day Thursday to observe Thanksgiving holiday. Then we just have a half a day on Friday closing at 1 p.m. And just before I get into the big event of today, Nvidia's earnings, just take a quick look at the Fed minutes we got. Basically just an insight into what Fed members are thinking from their last meeting. And that showed that all of them agree monetary policy must remain restrictive for some time until inflation is clearly moving towards the 2% goal. And they're kind of all in agreement that the risk to inflation remains to the upside. So they're still talking tough and want to keep the window open for another rate hike. And they're more worried about a resurgence in inflation opposed to overdoing it and keeping rates too high for too long. They know the economy and markets are pretty healthy and holding up, so there's no need to talk about cutting rates anytime soon. And just looking at the government bond yields, they didn't react too much to that. Actually just came off a little bit in the 2-year to 4.88, and the 10-year just kind of sitting at the top of this support zone at 4.39. But we did see Fed fund futures start to give a little bit of a possibility to a rate hike in a couple of weeks when the Fed meets for the last time this year, and a 5% chance in January as well. However, for the most part, the market still expects the Fed to start cutting rates come May, whereas the Fed themselves are saying they're going to keep it higher for longer until inflation well and truly comes back down to 2%. So for that to happen, we really need to see some cool and CPI prints and other inflation data, if not something else big breaking in the economy. Moving on to the big event of the day, Nvidia earnings we just got after close as I speak. And once again, they blew past estimates, showing huge growth in their revenue and earnings. And so revenue growth came out a huge 206% increase on its latest quarter at 18.1 billion. That was well above analysts' expectations of 16.2 billion. And same deal with earnings per share coming in at $4.02 versus Wall Street's estimate of $3.37. So that's a huge beat. And the revenue is up 279% from the prior year. And this is on the back of demand for their GPUs and CPUs that were previously the biggest sellers to gamers. However, with the AI boom, a lot of companies wanting to get into generative AI are needing to stock their server farms with these really powerful GPUs that Nvidia has. And just looking at the price action in Nvidia today, in the regular session, we finished down just under 1% at $4.99. And I'll just take you down to a 5-minute chart post-market. You can see after we initially got the results, we did a sharp dip right all the way down to $4.68. That was probably an erroneous trade on a loose spread. How it stabilized and we're still trading down 1.2% to $4.93. So there was some concerns about their ability to sell to China with the US government export controls. However, they have come out with lower performance chips that kind of skirt around those export controls. And they're saying that doesn't have a big material effect on their business. However, the fact is we have rallied 28% since the start of this month. So I think the market kind of already got ahead of this earning result and front ran it a bit here. And what we're seeing is probably a bit of buy the rumor, sell the news, and a bit of profit taking. Because if we were still trading around 410, 420, we probably would have done a big gap up close to where we are now. But the market's kind of already done that in the last month. And so by the looks of it, we're going to be consolidating just below 500 tomorrow. And at this stage, as I speak right now, the market looks to have got a bit ahead of itself and foresaw these really good results coming in. And just looking at the Qs overall, we're just trading down a bit, 0.14% after hours as I speak. So once again, we'll be watching how Nvidia trades tomorrow and whether that holds under 500. as that is a very important key stock in the market. And Nvidia has been the best performing stock out of the Magnificent 7 this year. It's a really concentrated trade amongst hedge funds and retail traders. A lot of crowding into it because as a group they've just been so persistently performing and seem invincible. And according to Goldman Sachs, the combination of elevated hedge fund concentration and the strong performance of popular stocks has supported returns this year, but lifted our crowding index to a record high. And you can just see in this chart here that outperformance of the Magnificent 7 versus the equal weight S&P 500. Truly a huge stark difference between the two groups. And there's a look at a clean daily chart of a composite of those mega cap 7 stocks here in the candles. You can see year to date they're up a huge 110%, and the orange line here is the S&P 500 equal weight. That's only up 2.8%. And so the theme next year is, will this big spread converge? And will it converge with the mega cap 7 pulling back, or will it converge with the equal weight, that is most stocks in the market, catching up to the mega cap 7? Because we've got these stocks now making up the largest concentration of the S&P 500 and NASDAQ indices. And this is one of the biggest divergences we've seen in the market when it comes to a group of the biggest stocks versus the rest of the market. And it's pretty much been the defining theme this year in the markets, on top of the AI craze. In addition to the stock market's surprising ability to hold up in the face of those Fed rate hikes. So stick with Click Capital and I'll keep you updated on this huge market dynamic and how this plays out over the coming months into next year. And just before we move through the rest of today's news and charts, if you are interested in getting of my other products and services you see on my website, clickcapital.io, then I recommend you take advantage of my Cyber Week special for the next couple of days. And so I'm an affiliate with 7 different trading software tools, including TradingView, Seeking Alpha, Market Chameleon, Simply Wall Street, Bar Chart, FinViz, and Trader Sync. And so when you come to my website, clickcapital.io, and you visit these websites through clicking these blue buttons, and if you make a purchase, send an email to me at support@clickcapital.io with the receipt or screenshot of your purchase, and I'll give you the same value of your purchase and free products and services of my own. And I've got custom indicators for TradingView, a trading strategy you can follow, and my latest investment presentation. You can just pick and choose how you want. And this is the best time of year to do your buying. This is when I buy all my tools and extend my plans. So if you don't already have a paid TradingView account, now's the best time to get it because you're going to save huge with their Black Friday Cyber Week specials, in addition to free credits on my website. And I also recommend getting Seeking Alpha, the #1 platform for fundamental research. I have a premium account with Seeking Alpha and they're really good, especially for news and analysis. You can get articles and research from a lot of different analysts, investment research companies, hedge funds, in addition to a lot of data for each and every stock, quantitative rankings, Wall Street, analyst ratings, all the financials, balance sheet data, earnings, everything you need to analyze a stock, including stock screeners that they've got, where you can use their special quantitative rankings to again hone in and find the stocks that you're interested in. And so taking advantage of Seeking Alpha Black Friday sale, through going through my link, you'll get the exact same 45% off that you would going to them directly. And if you spend $239 with them, you'll also get that in free credits for whatever products and services of mine that you want. And there's other cool tools like Trader Sync, a really cool trading journal. You can pull data from over 240 brokers to give you a bird's eye view of all your trading analytics performance, find winning and losing patterns, set up a track record, and they too have a huge 65% off in their Black Friday sale. So if you're interested in that, head on over to my website, clickcapital.io, click on the big red banner up the top, have a read through the 7 different tools. You can take free trials to them. However, before you can get free credits with me, you need to send proof that you made a purchase, even if that's in a few days' time, and you'll get yourself a great tool at a great price, plus some of my products and services for free as well. So I'll put the link below this video in the description if you're interested in taking advantage of that. And like the old market saying goes, nothing changes investors' minds like surging prices and the fear of missing out, FOMO. That's why we got signs stocks are finally attracting investors' cash, with inflows of about $23 billion into equity funds last week, which is one of the highest totals we've seen this year. And the market's really flipped from bearish to bullish in quite a quick fashion here. And we can see that in the AAPL Investors Sentiment Survey, with the bullish reading now climbing back up to 43.7%. That's getting towards those levels we saw back when the market topped around 51%. And same with the sentiment of active investment managers. That's climbing back up now at 72%, and that was coming off yearly lows down at 24%. A lot of people got really bearish down there when the market was technically oversold, and now a lot of people are coming back to the market once again at highs. And they could be right, because we've got one stock market indicator showing the current rally is poised to extend through next year. That's the S&P 500 sector correlations, suggesting the stock market rally still has room to run through the end of next year. That's the correlations between some sectors in the S&P 500 are consistently hovering around their 5-year average level, which is sending some positive signals as investors see clear skies ahead and are willing to pick and choose between individual sectors and stocks. So looking at the 30-day rolling correlation of the tech, industrials, consumer discretionary, financials, healthcare sectors to the S&P 500, 5-year average correlation is 0.83. That's kind of a boundary line between good and bad equity markets, and when correlations run above that level, stocks tend to be under pressure because investors see too much risk in owning stocks as an asset class. As a result, everything gets sold in such an environment. On the other side, when correlations are consistently below that level, stocks tend to rally. And S&P 500 does not tend to see a near-term top until correlations are well below average, and we are far from those levels now. So we do have a bunch of technical signals saying we've got some more price growth ahead, and we are starting to get back to a bullish consensus in the market. And a lot of people are expecting next year to be a good one as well. However, like I've been saying, the bond market is forecasting a recession. And looking back through history, it's very rare for stocks to rally throughout a recession. They most likely crash. And just moving on to the commodities market, we had oil pull back a little bit today on the back of some more increases in supplies. And ahead of the OPEC Plus decision this Sunday, where we might hear some extended production cuts coming out of the Saudis and others. But for now, these lower oil prices are helping the economy. And for my North American friends, I'm sure that's a welcome sign for those of you that are driving over Thanksgiving weekend. Help keep a few extra bucks in the pocket. And just looking at the price of crude oil futures here, it too in a really low volatility, low volume trading range today, calling up in an inside day at $77 a barrel. We also saw the shiny precious metal gold close above that big psychological $2,000 an ounce level for the first time in a while, coming back to flirt with all-time highs. And we continue to see a lot of strong buying coming out of central banks in their pursuit of de-dollarization. And gold's seen a pattern of strong buying coming out of Asia, with India importing significantly more gold in October than was forecasted. India is a big user of gold, especially with jewelry. Amongst the wealthy, it's seen as a very symbolic sign of wealth. And combine that with rates coming off recent highs, hope for a Fed pivot and a weaker US dollar, gold could take a stab at all-time highs above $2,100 an ounce before Christmas. And there's a look at the daily chart of gold there, which has been hovering sideways. For the last 6 months, we found some good support down in the low 1800s. Just before the conflict in the Middle East kicked off. Went into a big flight to safety trade. We pulled back, found support at the 50-day, and here we are again, pushing up against that big resistance zone and just taking you out to a weekly chart. It made its all-time high back in August 2020 at $2,089 an ounce. And so technically speaking, the more we keep pushing up against this resistance, the weaker it gets and the more likely we are to break out. And for those of you watching my channel, you know I'm a long-term gold bull and I have strong conviction that we are going to find all-time highs in the coming weeks, if not months. And if we see the US dollar resume a downtrend, that's just going to give a lot more tailwind to gold, and that could be setting up for a good 2024. We also got yellow cake, uranium, prices topping $80 a pound for the first time in 15 years as demand for nuclear power surges. And once again, for those of you following my channel, know I'm also a uranium bull long term, and that's because the world's coming back to it because it is the most efficient form of energy if done safely. And this is an industry I think could do well next year as well. We've got about 2/3 of the world's uranium mined in Kazakhstan, Canada and Australia, and there are roughly about 60 nuclear reactors under construction globally, and they need about 30 million pounds of uranium a year when they start operating. And there's a look at the uranium ETF URA, finding new year-to-date highs today, finishing a little bit lower, and just taking you out to a weekly chart on that one. That too is pushing up against highs it made back in November 2021, and technically and fundamentally uranium is looking good here. And it looks like most investors have given up on China, and that's part of the reason why I'm interested. I'm betting on their largest internet company, Alibaba, as a contrarian trade, as foreign investors have dumped more than 25 billion worth of Chinese shares this year, and that's 77% of the money they previously invested in China's stock market gone. And that's obviously for good reason. Not only the huge problems in their property sector, the West deleveraging from China, them partnering closer with Russia, and the government constantly alternating between capitalism and communism does make it a bit of a minefield. However, what's got me willing to make a punt was listening to Xi's speech in San Francisco to business leaders. The fact that he even stood on US soil for the first time in 7 years after the escalating geopolitical tensions we've seen this year is a strong sign to me. He wants to come back to the table and do business. And if you listen to his speech, it sounds to me like he doesn't want a war with the West, at least not now. which is probably not for at least a couple of years. He's recognizing the problems in his economy, acknowledging the leverage the West has over them, especially when it comes to AI and chips, and in my opinion is trying to do the right thing by his people and stem the decline in growth rates they've seen over the last year or so. In addition to that, he's escalating stimulus at home, trying to put a floor in the economy, and just looking at a weekly chart of the China 50 index, pretty much their equivalent of the S&P 500. See, it's been in a bear market for 2.5 years, and technically speaking, potentially looks to have found some support around here and may be de-risked here. But specifically, I like Alibaba as a risk reward, $194 billion for their biggest internet company. And when you strip out cash, it's got an earnings yield over 11%. And you compare that to the American equivalent, Amazon at 1.48 trillion, PE of 76, so earnings yield of about 1.3%. And so although I'm dipping my toes in the water, I think it could be a good risk reward, especially we're just trading at over $100 a share back in August. Here we are around the mid-high 70s with my stock fair value indicator showing it at $111. And with my time frame on this one, at least 1 year, probably more like 2 to 3 years. And this would be a big contrarian play because a lot of people have just given up on China, like we saw in that news article. And typically when the crowd is leaning strongly one way, it can often be a good bet to go the other way. So stick with Click Capital and I'll keep you updated on how that turns out. We also had news out today. Binance founder Changpeng Zhao, also known as CZ, is going to step down and plead guilty to criminal charges relating to violating US anti-money laundering requirements, in addition to a huge $4.3 billion fine on Binance, as once again US regulators try and crack down on the industry in an ongoing battle back and forth. And it's not all vindictive action from US regulators. CZ did shoot himself in the foot by doing a little house trading himself with 300 accounts linked to him, as like a lot of members in the crypto industry that just can't help themselves from doing dodgy stuff. And these 300 accounts that he was trading under, he tried to sweep underneath the rug, didn't report that. And like the old saying goes, where there's smoke, there's fire. And so running a multi-billion-dollar company wasn't enough. He had to do a little trading on the side, and so he deserves what he got here. Moving on to economic data we got out today. Canada's core inflation rate coming in a little higher than expected, but their headline a little lower than expected. Existing home sales in the States month over month dipping a lot bigger than expected. And there's those crude oil stock change inventories coming in a lot higher than expected. There's the fear and greed index climbing again to 64, starting to get to elevated levels here. And once again, a bit of selling in corporate insiders yesterday. 182 sales to 99 purchases. And just diving into the charts, starting with a look at my custom indicators, institutional buying percentage, still in a neutral zone at 47%. And there's the S&P 500 oscillator, kind of hovering in the overbought zone at 61. Looks to be walking the line, and we can see that in the daily chart. The S&P just kind of hovering in this resistance zone, still deciding whether to turn that into support. And like I said last week, I wouldn't be surprised for the market to come up and test those year-to-date highs at 46.07 in the remaining 2 sessions of the week. However, it's likely we just consolidate on low range and low volume, and possibly next week we come up and have a look at that level. We are starting to get a little bit of a divergence on my hidden divergence indicator, and a bit more so on the NASDAQ, which actually broke out to new year-to-date highs yesterday. But we're just really coiling up here. International stock markets pulled back on Tuesday as well, and what's looking like a pretty sleepy week. The VIX falling again to 13.3. Volatility risk premium remaining negative, and not too much big changes in breadth as well. We've still got new highs outperforming new lows, so breadth is holding up pretty good. And a little bit of a pullback in high beta versus low volatility stocks, and continued pullback in the spread of inflation expectation. Really low range, low volume day in the bond market, with high yield bonds continuing to trade well, and a little bit of a pullback in Bitcoin. Still trying to turn this resistance into support above 35,000, and a little bit of a bounce back in the commodity index as a whole. And over to stock sectors, mostly red out there, kind of flipping what we got yesterday with the high growth, high beta stuff turning back down, with the winning sector being cannabis, up 3%, continues to trade differently from the rest of the market, and the losing sectors being clean energy, regional banks, and continued volatility in biotech. There's the largest shipper in the world, Maersk, down over 3%, continuing to trade weak, and there's the big fella, Microsoft, consolidating at the top of this range. Just the latest look at Nvidia in the post-market as I speak, still down 1.3%. Tesla was the best performing of the big guys, up 2.3% today. A lot of weakness in the meme space, and then we had a bunch of earnings out from retailers today. Kohl's, American Eagle Outfitters, Best Buy, and lows all falling today on the back of their earnings results. Bit better price action in the defense contractors, a little bit of a pullback there in Intel, and the snack makers continuing their bounce off their lows a month ago, along with a bit more up and down messy price action in the regional banks along with the big guys as well. Okay, to sum it up, pretty low action, sleepy day in the markets like we normally get in Thanksgiving week. A lot of people gone on holiday. We don't typically get big moves in this week, and we seem to have a bit of a muted reaction to the Nvidia earnings result. Like I said, I think the market got a bit ahead of itself and kind of front run this result, so I was really expecting a good result. If it came in anything less than spectacular, we probably would have sold off pretty hard here, but they already blew it out of the park on the numbers, and the market just seems to be doing a bit of profit taking into that, and we'll see whether it can hold above $500 as the big psychological level tomorrow. Otherwise, we're currently trading at $492, so it looks like we're going to gap down. And we'll see where we finish the day for a bit of key insight on how the market's feeling about that. That's all I got for you today in this slow Tuesday. Unfortunately, I won't be able to do a show tomorrow. Got a scheduling conflict I wasn't able to change. And the following day is Thanksgiving, where markets will be shuttle day. It's like to wish my North American friends a happy Thanksgiving. And I'll be back on Friday night with a show to summarize the half-day trading and the week. And we'll take a look at how the market finished the Thanksgiving week and what we could expect going into next week. But that's all for now. Thanks very much for tuning in to Click Capital. And if you consider yourself a serious stock investor and trader, I highly recommend take advantage of Seeking Alpha's Black Friday sale. Save yourself 45%. You'll only pay $239 for an entire year's access to their platform. It's got a huge amount of data, a lot of great commentary and research. This is where I do most of my research when I'm investing in a stock. It's the #1 online tool. They've been around for almost 20 years now. And if you do take advantage of their sale and spend $239 with them for a year, you can also come to my website and take a look at my tools and services and get $239 worth of credit as you please. All you got to do is forward me a receipt. Make sure you first visit the Seeking Alpha website through clicking on the blue button on this page. That way it'll show to them that I referred you. They'll share a small commission with me. Comes at no extra cost to you. And then just forward that receipt or screenshot to my email, support@clickcapital.io. Tell me what products and services you want of mine, and I'll forward them to you same day. So if you want to take advantage of this Cyber Week special, head on over to my website, clickcapital.io, and click on this red banner to learn more. All right, guys, thanks again for tuning in, and I'll see you again Friday night. Cheers.